Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite, we have Milind Sharma. He's the CEO of QuantZ Machine Intelligence Technologies, and he's here to discuss the evolution of quant trading and technology. It's great to have you with us at MarketSite, and it's definitely a different game in quant finance than it was in the early 2000s, that's for sure.
That's right. That's right. I mean, you know, I started in the mid-90s, and I've seen the quant sort of landscape evolve quite a bit. It's come from what used to be a lot of exotics and derivatives pricing type of focus, and that was the first wave of, you know, the rocket scientists coming to Wall Street, which used to be more of an old boys club, and suddenly the quants got in and, you know, sort of shook things up a little. And then the second wave arguably was, you know, algo trading and execution related, first in equities, later fixed income. The third, I suppose, would have been credit derivatives and CDOs, and we know how that ended. and you know, and then sort of, so after the crisis, a lot of enthusiasm about opaque structures faded. People wanted transparency, factors, smart betas, things that were easy to understand. And now I think we're in that sort of, at least the fifth wave that I've witnessed, which might be about machine learning and taking either simple stuff or already complex things and sort of making them even more complex and less transparent, perhaps.
I mean, who would have thought in the early 2000s that machine learning and artificial intelligence would really be driving investment decisions and how we look at these data sets and translate them into factor investing. What are some of the trends that you're seeing there?
So, I mean, on the factor investing side and smart betas, I think that's a very interesting space because, you know, for the first being that we argue you can express, at least in equities, any kind of linear view using factors. So if you've got enough of them, and we like to think that our library is pretty comprehensive, you can basically express any kind of view that people used to do with simple growth, value, momentum, quality, leverage, liquidity, you know, this, that, all those types of things. So then the second part of it is, well, okay, so now you've got the tools to express those views. How do you factor in the cyclicality that's inherent to growth or value or all of these factors? Well, so that's where you get to the regime-based sort of timing and tilting of factors. That's sort of taking it to the next level. And then the third would be, okay, well, how can we combine this with machine learning and throw some, you know, bagging and boosting and random forests and all of these new techniques that are emerging at the same data, which clearly hasn't been done up until now. And it's, you know, we've got some results that look really promising. Again, the challenge will be just like with optimization 20 years ago, will people buy it?
Right.
Is it too opaque? I mean, do people trust optimizers? Well, eventually they did, and, you know, I mean, Harry Markowitz had done it in the 60s, but it took a while for people to buy into, you know, quadratic sort of optimization and the mean variance efficient frontier. So I think the same thing's going to happen in the machine learning space. That they'll go in kicking and screaming, and eventually there'll be a comfort level about these newfangled techniques.
Well, what about active versus passive versus smart beta?
Yeah, so I mean, you know, it's no secret that active hasn't done too well lately. Actually, the last 15 years, I believe, 90% of active managers have lagged. And I think post-crisis, a lot of that just has to do with the Fed sort of global coordinated central bank intervention that has killed active management because of the low, artificially low interest rates. But that'll, of course, normalize over time. But, you know, a lot of money's flowed into passive, which is not the right answer either, because the passive ETFs and indices they've gone into are kind of the sort of dumb cap-weighted ones, and that's not the right answer. So we would like to argue that it should go to the optimal stopping point should be quasi-passive. It should be smart betas and, you know, the next generation of ETFs that start combining factors, perhaps one or two at a time, and eventually multi-factor, and then you'll start seeing things that actually look like real hedge fund portfolios in an ETF wrapper.
All right, Milind, thank you so much for joining us at MarketSite, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.